Mutual fund investments are subject to market risks. Read all scheme related documents carefully.
Usually we discuss sectors, companies, businesses, and we have always been saying that we don't have competence to predict macros. And again, this is a statement by a Chinese philosopher. Those who have knowledge don't predict, and those who predict don't have knowledge. Despite this, the question that typically gets asked is market kya lagta hai? Despite saying in number of times, we don't have a clue as to what is going to happen in the future. And given the way 2016 has panned out so far, most of the thoughts that people have are pertaining to whether China will go bust or hard landing versus soft landing, what will happen to oil, what will happen to our banking system, and so on and so forth. So again, I don't have answers to a lot of these, but it will be interesting to put in perspective where we stand today. Leave aside where we are going. Just getting a perspective on where we stand today is by itself something that will give us perspective when markets are down 5% in a day or up 5% in a day. It will help us keep our heads level. And basically what I've pulled together is a few numbers, charts, a few discussion points. We'll have a chat on these. So first let's look at cyclicals and what has happened. The favorite discussion topic of most people of business channels. This is crude oil. You may not be able to read the numbers, but you can see the line surely, I guess. The white line which goes up and down like the Himalayan ranges. So a commodity which traded at $140 is now trading at 28. But leave that aside, look at this period, the period from here to here. So as late as 2004 or thereabouts, we were at $20. So it's not that the situation today is something which is exceptional. This is the nature of cyclicals. As we will look at many charts going forward, it's in the nature of commodities that prices keep going up and down for small supply shocks. Leave aside oil, I'll give you a commodity which is much more familiar to us in terms of our daily consumption. Onions. We see prices of 100 rupees a kilogram and we see prices of 10 rupees a kilogram. Something which is going to be consumed, but where supply keeps going up and down erratically, has these kind of shocks. So one, in terms of commodities, don't try to predict too much. And second important point is, there is always an element of what is referred to as mean reversion. Mean reversion, coming back to the mean or the average price. So what happens when onion prices go up to 100 rupees? When onion prices go up to 100 rupees, people try and substitute that with something else. Especially people who have an option to do so, restaurants and so on. Farmers will plant more of the crop, will try and increase output. That output takes a while, it doesn't come immediately. But eventually the supply comes and the prices come down. Same thing applies to oil, iron ore, coal, aluminium, copper, whatever it is. A supply shock creates very high prices, consumers try and adjust, meantime producers work very hard to bring supply back, and these things go to extremes. When producers put in a lot of effort to increase supply, many a times the increase in supply far exceeds the requirement, which causes the price to drop even below the average or below where it should logically be. So, in terms of scale, this drop is as steep as this drop. If we were to zoom out and cut out this portion, even this drop would look very scary over here. So it's not that something unique is happening right now, it is the way the market has been always. Coal, again something which was close to $140 at $49. Aluminium from a peak of 1473, from a peak of 3114 down to 1473, peak of 9600 down to 4331, steel peak of 880 down to 395. This is interesting. Shipping index from a peak of 9600 down to 373. So imagine you could let out a ship for something close to 10,000 a day. Now you are getting only 373. Erosion of 96% in your selling price. So what do all these charts tell us? These charts tell us two things. Firstly, if you are a primary producer in any of these, primary producer meaning if you dig a hole in the ground and take out oil, or if you dig a hole in the ground, take out coal or whatever else, iron ore, alumina, or you melt that and create your finished goods, you are in trouble, your shareholders are in trouble, people who have lent money to you are in trouble. And here, don't make a mistake of looking at dividend yields, looking at price to earning ratios. So, Peter Lynch, who's considered to be one of the best fund managers and who's retired now, of course, but who used to run the Magellan Fund historically, he said a proven formula to halve your money in a short span of time is to buy a commodity company when the prices are peaking at a low price earning ratio. The price will not go up, the earnings will crash. So what was a low price earning ratio will become a very high price earning ratio, or will become an infinite price earning ratio. So just as a thought experiment, you own a ship which you could let out for 10,000 rupees a day. Now it is giving you only 400 rupees a day. How does it matter what were your earnings last year? Your earnings this year and going forward will be completely different. Most likely you will be in losses. So whatever dividend was paid in the past or whatever the EPS was in the past is not representative of what will happen in the future. So sometimes you may be tempted looking at dividend yields or looking at price earning ratios. Be very, very careful. If it's a primary commodity player, past may not be reflective of the next 1, 2, 3 years. again, people, when Janet Yellen was supposed to talk about interest rates and convey the decision whether Fed is hiking interest rates or not, for I think almost a week on business channels, nothing else was discussed, only the Fed rate was being discussed. And after the 25 basis points increase, suddenly, oh, Fed is now hiking rates, there's a new world, all the money will move to US, or we are now in a higher interest rate scenario. Let's look at what the reality is. This is the interest rate chart of 10-year government bonds, starting from 1964 to date. Some people may be surprised to know that US government bonds yielded 16% in 80s. 16% per annum, US government bonds. That interest rate is down to 2.03 today. And look at where 2.03 is. It's close to all-time lows from at least 60s. So it's not that money has become expensive. Moving from 0% interest rates to 0.25% interest rates, overnight money does not make money expensive. That is US bonds. Switzerland, if you buy a 10-year bond, you pay 100, on maturity you will get less than 100 after holding for 10 years. Some banks are now charging you to keep money. So anyone having idea of taking some money out and opening a Swiss bank account, have another thought. They'll pay you less as compared to what you give them. Germany, 0.5%, 10-year bonds. All of these are 10-year bonds. Swiss minus 0.2, Germany 0.5% positive. Again, in Germany, I think 5 or 7 year bonds are negative. It's only 10-year bonds which give you some positive yield. French bonds, 0.9%. Japanese bonds, 0.2%. So this is the world that we live in. After all the panic selling is done, let us say you feel markets are going to crash, as I think some RBS report said, sell everything and come in cash and things like that. Don't own any equity. The world is coming to an end effectively. When you have done all of that, when money is in the bank, whether you are an individual, whether you are a corporation, pension fund, endowment, what will you do with that money? Serious question. What will you do with that money end of the day? A safe haven which used to be gold again has not given any return. It's been falling in recent years. Real estate, which used to be something where people felt that prices only go up, never come down, has seen a crash in 2008 in developed countries. So is it any surprise when Japanese bonds are giving you 0.2% that Japan is willing to fund our bullet train? It makes sense for them. It makes sense for them to give virtually free money in return for some orders which will come to their industry, which will create some employment, some economic activity. It's good for us because we are getting free money. Some infrastructure will come in place where there was none earlier. Now, I don't know what is happening to equity prices or what is going to happen to the world or what will happen to China's GDP or whatever. But if someone were to offer me money at negative rates for 10 years, I would be happy to borrow like the Swiss government. Take money for 10 years and buy a company like Nestle, which again is a Swiss company. Nestle is somewhere about 20 times earnings. So if you buy a share at 100 rupees or 100 Swiss francs, whatever, it will give you 5 Swiss francs in earnings. In 10 years, it will give you, in zero growth scenario, it will give you 50 as earnings. And after 10 years, you have to just repay the principal. In fact, it's negative, but assume zero. You have to just repay the principal. So, there is no alternative to equities given the world that we live in, because after the dust has settled, as long as what you own is not in the primary commodity space, as long as you are not owning a shipping company or a ONGC or a Kane kind of thing or a Vedanta, finally, as long as your company is going to earn decent profits for its shareholders, is not going to go into liquidation, in a world of free money, money has to again come back to the same asset, because you can't keep money in the bank. This of course is well known. So, given the extent of crash in commodity prices, a whole host of countries are in trouble today. Whether it's Saudi Arabia or UAE, Brazil, Russia, Australia, to an extent Canada, a lot of these countries were, Norway, a lot of these countries were making hyper profits on account of these commodity shortages or commodity price spikes. But today that is reversing out. So if you look at the countries which created sovereign wealth funds, where the plan was that extraordinary profits are parked in some vehicle and they will help out in times of difficulties. Most of the sovereign wealth funds are from countries which make resource profits. So whether it's Norway, Saudi Arabia, Abu Dhabi, Kuwait, Qatar, all of these are resource rich countries. And in fact, the budget deficits have gone so haywire that countries like Saudi Arabia and all have issued bonds. They never used to borrow, and they are rapidly running down their reserves because the selling prices are so low. And there is talk about countries like Saudi Arabia and UAE and all imposing corporate taxation or personal taxation. So far, there was no tax levied on citizens in these countries, and they could also be forced to look at things like cost cuts and all that. Singapore Sovereign Wealth Fund, I don't see why that should be a problem. Surprisingly, China has been running down resources. I don't know why. Some people attribute it to some capital flight, capital moving out of China in anticipation of currency weakness. This is a puzzle to me. I don't know the answer for that. But some of the selling that you have seen globally could be a result of sovereign wealth fund selling. It's not a reflection on economic conditions or anything else. Some of the money could just be going out because it is needed elsewhere. So when there is a shock of this magnitude, apart from the obvious winners and losers, there are other effects on the marketplace. So obvious things would be, anyone who uses oil will benefit. So airlines will benefit. There will be more travel because petrol is cheaper. Auto sales could go up over a period of time. People will drive more. Things like that. But second order is that a lot of companies which were in the resource space have started defaulting in the US. So the high yield bond market is crashing over there. From most accounts, it does not seem to be as big an issue as the subprime kind of thing, but at least a segment of the bond market will get affected wherever people have invested in those companies. Similarly, banks in India and elsewhere, whoever have lent money to such companies will have that much of an impact. Despite best intentions, the borrowers may not be in a position to repay loans that they have taken. So again, I don't know what will happen to oil prices 6 months from now, 12 months from now. But one thing is certain, that if prices remain low, a lot of production will go off market. In fact, yesterday there was a very funny story which was put out by Bloomberg and some other media. A particular grade of crude oil traded at negative 50 cents. Negative 50 cents meaning if I was to offtake your crude, I would expect to be paid 50 cents rather than me paying anything to buy that crude. This was because it was a low grade crude and production was just happening. There was no place to store, pipeline capacity was not easily available. So the buyer demanded a price to offload that crude and got paid 50 cents. So in such a scenario, crude which is extremely difficult to obtain, which has to be transported over long distances, those kind of oil will go out of the market itself, giving some stability to the prices. So some people keep following the trend. Whenever prices are rising, they say it will keep going up. So when crude was 100, they said 150. When it reached 140, they said 200 and 250. Goldman Sachs was making all sorts of projections. Now when it's falling, people say it will go to 15 and 10 and whatever. So far no one has said free, but maybe someone will come out with that projection. But if prices stay low, a lot of supply will go off the market, and especially shale oil and shale gas, which is extracted in the US. The reason being that shale oil is like running on a treadmill. You have to keep drilling wells to keep the production at the current level, because each well dries out very fast. Now, given the kind of prices, currently it makes sense to keep producing from the older wells. But once the older wells start drying off, it is not economical to drill new wells and extract crude oil. In fact, a lot of these companies are going bankrupt, so there will be no one left to drill oil at these prices. So you may not see a $25 or $28 oil permanently. You could see some small rebound. It may not go to 100 or 140, but somewhere it will bottom out. It will not be that it will always remain cheap and always keep falling. Capex will fall dramatically. So again, if you are owning shares in oil exploration companies or in companies which supply these rigs or things like that, capex will dry out and you have a long waiting period ahead. In terms of our foreign exchange, we saw this in 2008 and 2009, where in a downturn, Dubai got into trouble financially. A lot of people lost jobs in the Middle East. People had to come back to India. So given the kind of environment that is there in the resource-rich countries, we could see job losses for migrant workers, and a lot of them could be coming back home, and the remittance economy that we have, that could suffer. The transfer payments could come down. A lot of people are very bullish on things like solar energy, wind energy, electric cars and all that. And I'm sure this is the future given the environmental concerns. However, there will be a big hurdle for these companies given the low energy prices. So the impetus for an electric car or the impetus for a wind generated power or for solar power goes up when oil is at 100 or 140 or when coal is at high prices. When energy is so cheap, when fossil fuels are so cheap, you could see a lot of these projects becoming unviable, even at the low interest rates that we have currently. So there could be some shocks coming in renewables. Another interesting development is when oil prices are high, a lot of ethanol starts getting produced from things like corn and sugarcane and all of that. And a lot of agricultural land gets diverted to fuel production. And when overall commodity cycle is down, energy is down, that becomes unviable. So again, land starts getting used to produce food rather than fill the petrol tank. Recently, there were these WhatsApp messages going around. I think Aditya sent me one, and where HDFC Bank's market cap exceeds the market cap of all the public sector banks in India. The way the market is behaving, it is almost saying that only one bank in India will be left in a year or two. Everything else will go away. We will not have any other banks in India. We have discussed the commodity dip. We have discussed that a lot of these borrowers will have trouble paying their bankers. But what people have to realize is that whenever a company goes into trouble, the first hit is to be taken by equity shareholders. First, equity shareholders have to be wiped out, and then the lenders get wiped out. So in a downturn, there will be a lot of forced sales of plants, projects, and even if some borrower goes into the NPA category, it doesn't mean that whatever you have lent to that person has to be written off, 100% of it. So even whatever numbers are there, whether 10% of our loans are bad or 15% are bad or whatever percentage of the banking system's assets are bad, there will be some recovery from that. It's not that the entire 15 has to be written off. So once you have these asset sales and all happening, some money will come back. But the more important point is that banks which have relatively lower problems and which are in a position to rebound faster will be the biggest beneficiaries. I'll tell you why. When there is a systemic problem in a sector, the competitive intensity goes down. Borrowing rates will fall faster than lending rates. Lending rates will remain elevated. So the spreads that banks have will remain at very high levels because a lot of that net interest income has to be used to make bad loan provisions. Now if some banks have very little problem on bad loans, those banks will start showing record earnings. So and we have seen this in insurance business, for example, and Warren Buffett keeps talking about it. Their insurance companies go out of the insurance market when there is very high competitive intensity, when insurance rates are very low. But after a big hurricane, like Hurricane Katrina or something like that, where the entire sector suffers huge losses, the insurance premiums skyrocket, and that's when they enter and grab more and more of the market. So it's a similar situation in banking sector. When the entire sector is reeling, when people don't have capacity to lend because of their past bad loans and things like that, the banks which have relatively lower problems, those banks will be in a position to expand their market share, earn high net interest incomes and so on. So actually it could be an opportunity for the better run banks. we have seen the gloomy side. We have seen how selling prices have crashed for things like shipping, things like crude oil and all that. Now we are going to the other side. Who are the people who will actually benefit? And this company just posted its results a few days back. The interesting part was, he was said anything else. Actually, I am not going to be talking about Hindustan Lever per se. It's more about their top line. What they reported was that our volumes went up 6%, but our sales in rupee terms went up 3%. So they passed on price cuts to their consumers. Despite passing on price cuts, their profits grew more than the top line of 3%. Their profits grew somewhere about 7%. And this after increasing their ad spending and spending on marketing. So this is actually a template for all the non-primary commodity players in the marketplace. Whether you are a car company, two-wheeler company, a consumer goods company, tire manufacturer, any and every company is going to be seeing reduction in input costs. You could be a real estate developer, you could be a cement company, fuel costs are coming down, paint company, any manufacturing business or any customer facing business which is not a primary commodity producer sees easing off of input costs. Inflation will be under control if this kind of scenario continues for us. Government fiscal deficit is under control because most of the fall in oil prices has not been passed to the consumers. Excise duties have been raised. They have money to spend on capex, whether it's rail infrastructure or roads or anything else, ports. And when input costs are low, where price cuts are given, where more money is spent on promotions, ultimately consumers benefit and growth will come in. So I think what is a problem for countries like Saudi Arabia or UAE or Russia is actually good for us. And I don't know why people become so pessimistic when these kind of things are happening. You can be pessimistic if you own K in India, for example. But why are you pessimistic on everything else? Another recurring question is what is happening to the pharma sector, sector which was a wealth creator, which was defensive, which gave good returns, suddenly having this sudden death kind of scenario. You see a FDA warning letter and suddenly prices crash and there's trouble across the sector. So the interesting part is that there are two countervailing forces at play here. At one end, FDA has got more resources, they have increased their inspection intensity, they are more strict with the pharma companies, and you are seeing all these warning letters. At the same time, in the US, there is a huge pressure on the government, on the healthcare sector to reduce costs. You have had some unscrupulous players over there. Shrekeli was one of them. It got reported in the media where they started jacking up prices of generic drugs by a factor of 10 and 20, making things expensive. So, US consumers want lower priced generics, want lower priced drugs. So, it's not that generics will go out of fashion. It's just that this cycle has to play out. The players have to be prepared to work at a more stringent level of quality checks, and then they will get used to it, and at the same time somewhere FDA will have to recognize that they cannot harm the consumers in the process of doing these inspections and putting out import alerts. So my view is that these things are temporary. Ultimately, they have to play out, and finally, the players have to come back in their main market, which is the US. People keep talking about China, what is going to happen to China, whether there will be a soft landing, hard landing, is it going bankrupt or what not. So, essentially, basically, only the stock market has collapsed in China. That's because prices had gone up to unrealistic level, and when those kind of things happen, there has to be a correction. But all the other things actually are not borne out by facts. So people who talk about hard landing and all that, fourth quarter GDP growth was 6.8, for the year 2015 it was 6.9. China is still growing, forget about recession. It's not even close to 0 or 2 or those kind of things. It's still growing at a very, very fast pace, and that too for a big economy. People keep talking about currency devaluation of China. If you look at 2016, Chinese currency rupee, Malaysian ringgit and Korean won. Actually, emerging market currencies, other currencies have fallen more than Chinese currencies. So it's not that suddenly our exports become uncompetitive vis-a-vis China or things like that. It's just that headlines hype up things so much. So in absolute terms, depreciation is somewhere about 1.3% since start of 2016. It's not that suddenly there has been some huge devaluation in the Chinese currency or anything like that. So I spoke about renewables earlier. The negative part is the low energy prices. Given low energy prices, renewables will have a lot of headwind coming in. But on the flip side, I don't see that sector going away. I still see that sector as a sector for the future. Reason being that the environmental problem is real. So recently we saw that odd even experiment in Delhi, the smog and all. Earlier the thought was that countries like China and India will keep on burning coal as much as required. First we need to get the economic growth right, give electricity to our poor people, give employment, food to our people. Let's worry about environment later. But that problem has become severe. The harmful effects are being seen. So I see that somewhere there will be a pressure to move away from coal and fossil fuels, irrespective of the price. And that is another reason why in the longer run, again, no one knows if there is a big war in Middle East, crude oil could again go back to 100 or 150. But otherwise, longer term, solar energy, wind energy, battery technologies, or electric cars, all of these are threats to fossil fuels and coal and oil. They may not go back to their heydays on a permanent basis. So, as such, you should be prepared to sell when things are going great for these sectors, rather than be very bullish on these from a 10, 15, 20 year perspective. We'll also talk about some of the stocks that we had discussed at this forum in April 2015. Some of the stocks at that time. So that presentation was titled "Emperor's Clothes Are Torn." So this is the same slide with some additional numbers. So we had spoken about these companies. The surprising thing is there has not been a very steep fall in these. The fall has been more in commodity-led companies given the way things have panned out. But Bosch has moved from this to this, United Spirits, most of them are down. Despite the fall, things are not at mouth-watering levels, especially for very high quality names. So on social media or in gossip circles, people keep saying, oh, there's a discount sale going on and customers are running out of the store and this is the time to get in and things like that. Still, it's not completely cheap. So the main India consumption stocks are not really cheap. I still think that the best opportunities would be there in the dull and boring manufacturing space where your input cost pressures are easing and where you will have a comfortable time rather than the very high, highly fancied consumption names or the high quality names. High quality names still have some way to go before they become really attractive. If you have them, it may make sense to hold on some of them. I have nothing negative against them and I have not done any detailed analysis. This has just been pulled out from maybe one of the databases. I have not even checked whether these PE ratios contain some exceptional items or things like that. But just to give you a sense that we are nowhere in a 2008 or a 2009 kind of mouth-watering prices kind of scenario. That is still some time away. The opportunities will be in either beaten down sectors in the private banking space or the good quality banks or good quality manufacturing companies, or very selectively if you have capacity for paying in some select cyclicals where things are down and down. So getting in SIPs, selective lump sum investments, and buy only where value is emerging rather than buy indiscriminately. It's not still an indiscriminate buying market. What will happen? So all this was the long of it. Short answer is I don't know what will happen. No one knows. I have given a perspective of where we stand, or rather than watching day-to-day movements or week-to-week movements, we have zoomed out and taken a bird's eye view of where the market is, where the different prices are, different sectors are. Hopefully it gives some clarity and will give some peace to us when we see the stock prices tomorrow either going up 3% or falling 3%. So happy to take any questions that you have. Yeah.
You spoke about oil. So recently IAEA lifted sanctions on Iran. So we expect Iran being the second biggest producer of the Saudi Arabia, there will be more supply. So it will bottom out after some time. So any comment on that? What Iran will have? What impact Iran will have as far as prices? And it's good for Indian perspective because we are the largest buyers as far as Iran is concerned. So we will have more windfall in terms of our imports.
So the supply increase will, from whatever I read, I'm no expert on oil in that sense. Initially, 100,000 barrels per day is what supply will get added. I think as a percentage of the overall demand and supply, it's not much. Even down the road, it will be somewhere around 400,000 barrels a day. Iranian oil will come in, some oil will go out in terms of shale and all. Exact timing we don't know. Currently storage capacity is completely full up. So even small increases in supply will cause prices to collapse because people don't have place to keep that oil. They would rather give away the oil than flood it somewhere. So temporarily there's no supply, no storage capacity, or that swing demand is not there. But I think things will even out somewhere down the line, maybe 6 months somewhere. Again, short answer is I don't know.
You know, maybe because of your mutual fund, just have you observed recently, maybe last 1 week or 2 weeks, the markets gone a bit lower, like 100 points and so. Which is because of FI pulled out or because of domestic DI selling out? Can you answer for that?
So I don't know specifically about last 15 days. Story of 2015 has been FI selling, domestic funds buying. I don't know specifically about the first 15 days.
Sir.
First 15 days, Mehul is saying the same.
Two questions. Is oil going down can be bad for Indian economy by any chance? That's one. And secondly, if oil is down at such a low prices, wouldn't India and these companies hedge their position for the next 3-4 years? So if there is any spike tomorrow, it doesn't affect us. Are they doing it, or how's it like?
India, to my knowledge, doesn't have a policy of locking in. So, countries like US and China have what are called strategic petroleum reserve. They don't just hedge in the markets, they actually buy it and store it in the ground in huge caverns and all of that. India, I don't think has that.
At least you can hedge the price, as in you can,
Using futures market, I don't know what companies like IOC and HPCL, BPCL do, but government on its own doesn't do anything of that sort. They may be acting through PSUs, but I am not aware whether they are doing that on an active basis. They don't seem to be, because when the prices went up the last time round, they were caught unawares. They went into huge losses.
how about the airlines companies?
A lot of them do. A lot of them do to the extent of their pre-bookings. So typically ticket sales happen in advance, and to hedge against those ticket sales, they also hedge to the extent of 3 months, 6 months, 12 months, depending on what kind of ticket sales have happened. Because if you have sold tickets at a particular oil level and then prices go up, then you would end up with losses. But these are not very long-term contracts. Prices go up and down depending on oil, so they would be matching with their ticket sales.
Can oil be bad for India? Sustained oil prices going down?
I don't see why it's bad for India, except for ONGC and KN. I don't see why it's bad for India. It's good.
Because your exports would slow down completely when oil is not consumed. The world is slowed down, so exports have slowed down. So it's not good for Indian economy. Any chance?
So oil coming down has no direct correlation with exports, except to the extent we import crude and sell refined products. That is a offsetting item that doesn't matter. So I take your point. Two things have happened. Oil prices have fallen over the past 12 months, and our exports and imports are down over last 9 months of the fiscal year. But causation, I don't think one is the cause of the other.
There was this interesting article in The Economist recently which showed the break-even price of oil for like different countries. And according to that, like apart from Kuwait and Saudi Arabia, there was nobody else who was producing oil like on a variable profit basis. I think Kuwait and Saudi Arabia were around $10 to $15 a barrel, and like America and Russia were like north of 60. So my question is, like, people have spoken about how like oil prices could remain low for really long, but when more than like 75% of the world is producing at a loss, like how is that sustainable? Like, so the only two reasons for that, right? So one is that that Kuwait and Saudi Arabia can produce that much oil that can soak up all the demand, or that demand in general is falling. So what's your view on that?
So it is said about statistics that if you torture them enough, they'll admit to whatever you want to do. So what happens is that different people use different parameters to, let's say, calculate the break even. So I remember reading this article somewhere. So I don't know whether we are talking about the same version of the article, but one of the articles was talking about break even for the country rather than for the oil companies.
Yeah, country. Yeah.
So that break even meant government finances rather than the actual cost of drilling and taking that barrel out and selling it in the marketplace. So for Saudi Arabia, the cost of drilling, extracting a barrel of oil and selling would not be more than $5, $10, $15. It's nowhere close to 50 or 60. Whatever those costs they are referring to are the government spending on their citizens, or state subsidies given and all of those kind of things which are there.
I think it was about the cost of drilling and taking it out.
So even taking that into account, so for any company, cost would be two. One is the variable cost of extracting something, and the second would be the fixed costs, which are incurred in creating the infrastructure, interest cost on that, depreciation and all of that. So in crude oil, among the biggest costs are first finding the oil, where the oil is, and then setting up the infrastructure to evacuate the oil. Setting up the wells and the pipeline infrastructure to take it to the port or refinery, as the case may be. Now those fixed costs have already been incurred. Whether oil is at $70 or at $30, as long as your selling price is above your variable cost of extracting, you will keep selling it. And as long as supply is higher than demand, what is your break-even point would not matter. It will only matter as far as creation of fresh capacity is involved. So sure, the shale oil will go off the table as wells run dry, but the conventional wells could keep producing for many years. Sure, they will not have money to create fresh capacity, but doesn't mean that the existing capacity will suddenly go away. So I am not, again, I think both of us are in the same camp. We are not saying oil will be in a continuous free fall, going to maybe $20 or $15 or $10. But the low prices could linger for a while. The rebound may not happen very soon. And again, I don't know how people calculate a lot of these things, but the world was comfortable with a $20 oil price in 2004. So from 2004 to 2016, let's say over a period of 12 years, any other commodity or any other traded good or service has not gone up so much in dollar terms. So why should crude oil's break-even point suddenly go up from sub 20 surely to somewhere close to 60 is my question. I don't have the answer, but again, many times what happens is break-even point is also a factor of supply and demand. Let's say when oil is at 100 or 140, the offshore drilling rigs and all that rentals go up dramatically. But when no one wants those rigs, the prices come down. So creating the infrastructure today may be far cheaper than creating it 2 years back. So some of these are circular arguments. You don't have a so when prices down, the break-even point also comes down, and when prices up, break-even point also goes up. It could be something like that.
So a bunch of the major oil companies worldwide have drastically cut their funding for new exploration and evacuation, and roughly I think the top 5 companies have cut it by maybe $400 to $500 billion, which is a large sum of money. So where do you think that money goes here?
Repeat the question.
The question is, all these oil companies have cut costs, they have cut staffing levels and all of that. So where does all that money go? The money goes to the consumer and to the governments in the consuming countries. So it goes to government of India, it goes to the US consumer who drives cars.
No, but I mean, for example, an oil company which may have set aside X amount for drilling and exploration, etc. They have decided to cut that spending down, but that money is still with the company. It's not that they're passing it on to the consumers or something.
So as long as they have the cash, it will remain in their bank account or in treasuries. If they have debt, then it will go to repay the lenders in terms of interest and principal amount, because that will be difficult to service from their core business operations.
Rajiv, whatever windfall gains Indian economy is receiving because of low commodities, especially oil, Indian government is playing it very smartly by increasing the excise duty. So we have got a very good indirect and also direct taxation. So what I'm saying is for our GDP to grow at certain levels, and there has been a consensus that Indian GDP will grow at the fastest rate in 2025 at least. So for this to happen, at least for the short term, government expenditure has to go up. So in this budget, do you expect, I'm not jumping the gun and expecting something to have some benefits for corporate taxation and all, but do you believe that government will try to do something which will sentimentally impact corporates so that it will have some impact on earnings in the short term, so that capex cycle will grow in the private space also, along with the government expenditure?
So one of the slogans at the time of election was minimum government, maximum government. Minimum government does not seem to be happening. It's been so far a tax and spend kind of government, but which is not entirely bad. Reason being that today we saw the banking sector is in trouble. They don't have capacity to lend. Neither do the typical GMR, GVK, Lanco, JP have the capacity to borrow and spend money on infrastructure or on anything else. So, in a scenario where the government is raising resources and spending money on roads, ports, airports, metro rail systems and all of that, that's the only way it can happen given the stressed balance sheets that are there. I don't see too much money being given away. Roadmap is there for reduction of corporate tax rates. That will be in tune with withdrawal of exemptions. Net they will raise resources.
The funny thing about governance is through SUTI they are holding ITC. On the one hand, they are taxing all the tobacco companies and they're still holding ITC. Why they are holding, I don't know. So they can at least look at that.
I don't know why they should own a tobacco company. Doesn't make sense. Yeah.
There's a lot of negative publicity in the papers for ICICI Bank. So what is the real story?
What's the negative publicity? Sorry, I seem to have missed.
Skeletons keep coming out. Skeletons keep coming out.
What skeleton? I seem to have missed the story.
No. Basically the CNBC and all they keep talking.
So specifically, what do they talk? I seem to have missed the story. What are they specifically saying?
He is talking about just underperformance vis-a-vis
A lot of skeletons keep coming out.
I think there was a story.
Forget lot. Let's talk about 1, 2, 3 or whatever. So stock price hasn't done well. People suspect that there would be some NPAs given their lending to corporates or some commodity related sectors. So that is a phenomenon across the banking sector. My personal feeling is that the private sector banks have it better than a lot of the PSUs, and to some extent the troubles are already in the stock price. Also, a bank like ICICI Bank also has other businesses in terms of the insurance play or the stock brokerage play or the mutual fund play and things like that. So, as such, I don't see what the issue is. There is an issue with the entire banking sector in terms of elevated levels of bad loans, which would be there to some extent for ICICI also.
So this is just a grapevine. I don't know the real story, but there is a story going on in the markets that Chandra Kochar is looking at selling home finance to Piramal Holding. This is just a grapevine. I don't know the reality behind this. But they are looking at it. So Shriram Transport Finance, they made a big investment, Piramal. So they're looking at selling Piramal home finance business, ICICI Bank. So just a grapevine. I don't know the reality.
Actually, the story was there was some strategic debt restructuring scheme of RBI, through which there was some 76,000 crores of new loans that were being converted into restructured assets through this scheme. And Axis Bank and ICICI Bank were one of the top two lenders who had exposure to these. There were other lenders also. So that was the story which I
Sure. So bad loans is a thing which is there in the entire sector, and a lot of these players have exposures to the commodity and infra players where loans have gone bad, and that is a fact. So how much pain is there in how much time will they take to bounce back is a difference in perception. So, market is effectively saying at the current market prices that HDFC Bank effectively will be the only bank left. Everyone else will go. So, that's the difference.
The other bank is well managed.
Kotak by the.
People like Kotak Bank, they have merged with ICICI, with ING Vysya. So ING Vysya had troubled assets. So to an extent they have to clean up post that, but people like Kotak Bank as well.
What about Axis Bank?
Axis Bank and ICICI Sudip Bhai would be similar. They have exposure to commodity players or to infrastructure players, and there would be loans which are going bad. But the prices are so beaten down that even if you account for those, the valuation has already incorporated that.
While we're at banks, I'll just ask. So,
Sorry?
while we're discussing banks, I'll just ask my question. So, basically, like Yes Bank, this is like a, I guess, conflict between like the narrative and the numbers. Because the general impression is that it makes out aggressive loans, but for the last 30 quarters, it's produced the lowest NPAs in the nation. And even in a bad year like 2008, I think HDFC Bank Kotak had like a gross NPA level of around 2%, whereas Yes Bank produced only 0.7%. So I wasn't able to really figure out why that's happening. Some people told me that's because they do a good job of concealing their bad loans and stuff like that, and maybe they're good at recovering money. But would you have any opinion on that?
So I don't have any special insights into the bank, but let's look at factual information.
Right.
Do they have a lower proportion of CASA as compared to the system? Yes. They depend on wholesale loans.
Right.
Are they aggressive in terms of paying higher deposit rates? Yes, because their savings bank pays among the highest interest rates, 7% and all of that. So if your cost of funds is higher and you want a decent margin, your lending rates have to be higher. If your lending rates are to be higher, it won't be to the AAA corporate names. It will be either to small and medium businesses or businesses which have been turned away from other banks. So I would monitor that number closely in terms of bad loans and all. Why they have reported low numbers so far, I don't have an answer to that question.
Base is pretty small for Yes Bank as compared to other banks.
So base may be large or small, but if you are lending to risky players, then that should show up on your P&L or balance sheet in a bad time. So why that number is under control, we don't know.
Yeah, but it's not been 1 or 2 years, right? They've been around since 2004, so that's 11 years. They produce the lowest NPAs in the nation. It's just surprising, but I guess. Yeah.
Sir, why HDFC Bank is on top? Because their infrastructure is in such a manner that nobody can play with that. That is why they are successful, HDFC Bank. No other bank has
Infrastructure meaning?
in the computer system and all other risk management. They are managing things. They are managing
So
better.
infrastructure is the same for the entire sector. Where
No, but I
HDFC
don't think so. I don't
where
think
HDFC Bank scores.
so.
And
Yes, they have a better system. Definitely better.
So where they score is, and there's a very interesting book on the bank from its founding years to the almost the present date. It's written by a person, Tamal Bandyopadhyay, a bank for a buck, right from the founding days where Deepak Parekh and Aditya Puri came together and set up the bank. I think where they score is in terms of the culture and credit processes. So the computer systems, IT infrastructure, ATM network, all of that is standard. So you have either Oracle selling you their banking suite, or you have Infosys selling you their banking suite. Everything is virtually the same. Where the difference is in terms of culture, in terms of
System.
playing a lot of emphasis on the documentation, the credit analysis, and all of that, not giving loan in a haphazard manner or being very cautious while lending. I think that is the key differentiator for the
Mid-managed also.
They say PSU banks are not doing well. US banks are doing very well, so people are buying. 6 months back, everybody started buying. Now PSU bank prices have come down. Do they become tempting by these prices, despite they are doing not as good as private banks like State Bank or something?
So in any other business other than banking, typically you can figure out which is an expensive company and which is a cheap company. What is the earnings, what is their book value, various parameters. In a bank, that is very difficult to do. So when we say banks are cheap, typically people refer to a ratio called price to book value. So this is the price per share, this is the book value per share, and what is the ratio. So HDFC Bank may be 3.5 or 4 or wherever the number is today. And some of these banks will be ranging from 0.75, ranging from 0.5 to 0.9 or thereabouts. So the price is in fact lower than the book value. The trouble is that you don't know with precision what the correct book value is. If the bad loans are so much that most of your book value is wiped away, then whatever price you are paying is an infinite price to book value because there is no book value. So where the net worth or the where shareholders funds is just maybe 7 or 8 rupees and the balance sheet size is 100 rupees, if out of 100 even if 10 rupees are bad, then that entire 8 rupees gets wiped out. So that's why I would stay away from banks where the problem loans are huge as a proportion to the net worth.
But government banks, we don't know the operation, how efficient it is.
So they have been trying to improve things, but whatever has gone out of the bank, you cannot recover it back. So if you have lent money stupidly in the past, you have to recapitalize the banks. You can't recover from the past follies. That's the issue.
What about banks like Jammu Kashmir Bank and South Indian Bank? They, on first look, they appear really cheap now. We know that there was a flood in Jammu Kashmir that sort of added to the to the woes of that particular bank. But they're private banks, and they also have they lend out corporate loans and all of that. And if you see their book is sort of changing now. They're going towards more retail and all of that in response to all of this. So how would you look?
So I think Jammu Kashmir's banks problem started even before the flood. In fact, we used to own it at one point in time, and at that time there was a pristine balance sheet. The moment we saw signs of trouble, we bailed out. Happily so, but I think the problem started much before the floods, and actually the more worrying part was that they started disclosing some of the problem loans only after some media reports came out and not before that. So we would have expected them to be transparent and be disclosing and making provisions on an ongoing basis. It's only when some specific corporates were named where they were not making provisions and so on. So that was the issue. South Indian Bank, I don't have an idea on the current status of that.
Just a remark. Basically, South Indian Bank and J&K Bank, they enter into a lot of consortium lending. And these lendings are generally private banks managed kind of things, and maybe some major public sector banks. And the problems are generally occurred in these kind of consortium lending projects, mostly catering to infrastructure sector. And South Indian Bank, for example, is a case in point where a lot of these loans have gone bad. So that might be a criteria of looking at how much. So what happens in the consortium lending, you don't do your own credit analysis. You basically rely on somebody else. And this is where the credit standards are not really applied properly.
Great, thanks a lot. We have overshot.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.